Form 706 is the federal estate tax return. It's not an income tax return. It reports the decedent's gross estate, applies deductions, and figures the taxable estate and estate tax. On the EA exam, a common trap is mixing up Form 706 with Form 1041. Remember, 706 is about transferring property at death. 1041 is about income the estate earns during administration. When is Form 706 required? Generally, when the gross estate plus adjusted taxable gifts exceeds the filing threshold, which is the basic exclusion amount for that year. For 2024, that's $13.61 million. But there's a huge exception. If the executor wants portability, meaning to transfer D Zui to the surviving spouse, they file Form 706 even if the estate is below the threshold. Timing is easy to test. Form 706 is due 9 months after the date of death, and you can get a 6-month extension by filing Form 4768. Key exam detail. The extension gives more time to file, but it does not automatically give more time to pay. If tax is due, you generally want to pay with the extension to avoid penalties and interest. Now, build the gross estate. It's based on fair market value at death, not what the decedent paid. Include property owned outright or partially, tangible and intangible. Also include life insurance proceeds payable to the estate, and even proceeds payable to heirs if the decedent owned the policy. Add certain annuities or survivor benefits, and watch the 3-year rule for certain transfers close to death. 2 quick exclusions to keep straight. Property owned solely by the spouse or someone else is not in the decedent's gross estate, and completed lifetime gifts generally aren't included, as long as the transfer was complete and irrevocable and the decedent didn't retain control. On the EA exam, they'll hint at retained control to pull an asset back into the estate conceptually. After you total the gross estate, you subtract deductions to get the taxable estate. Big ones: funeral expenses, administration expenses, and debts at death. Then the major transfer deductions: marital deduction for property passing to a U.S. citizen spouse, and charitable deduction for qualifying charities. Also, state death taxes can be deductible. Easy trap: federal estate tax paid is not a deduction from the gross estate. One more coordination point. Administration expenses can be deducted on Form 706 or on Form 1041, but not both. That's a classic double-dip trap. And remember why Form 1041 might exist at all? If the estate earns income during the administration period, like rent, royalties, or even interest, you may need annual 1041 filings until the estate is closed. Non-resident alien beneficiaries can also trigger 1041 filing even with low income. A qualified disability trust, or QDT, is an example of what type of trust. Your choices include an abusive trust, an irrevocable trust, a grantor trust, or a revocable trust. Think about what qualified usually implies for trust structure and control. Think about it. The correct answer is an irrevocable trust. A qualified disability trust is set up to meet specific tax rules, and it's not something you can freely undo, so it's irrevocable. The tempting wrong answer is revocable, because many people associate disability planning with flexibility. But for QDT status, the trust is not treated as revocable. The executor of a decedent's estate chooses the estate's accounting period based on which statement. Options include: it must be a fiscal year tied to date of death. The executor chooses calendar or fiscal when filing the first return. It must be calendar year unless IRS approves, or it's based on date of birth. Think about it. The correct answer is, when filing its first return, the executor can choose the calendar year or a fiscal year. Estates have flexibility, and the choice is made on the first Form 1041. A tempting wrong answer is that it must be tied to the date of death, because that sounds logical, but the rule is about the executor's election on the first filing.